Hi everyone, Ben Johnson here with Teacher Moolah today to talk about taxes. Tax season is upon us. Many of you are probably getting ready to file your own taxes right now. Just a quick disclaimer, I'm not a CPA. The US tax code is incredibly complicated and there's lots of weird rules. For example, in the state of Texas, cowboy boots are not taxed, but hiking boots are taxed. So if you have any specific questions, definitely reach out to your CPA. Although I will tell you that if you have a pretty straightforward tax situation, you should be able to file your own taxes using the free tax software that's out there. And if you've got a more complicated tax situation like a rental or something, then you can upgrade to, say, TurboTax Premier, and it's going to talk you through filing your taxes. I actually prefer to do it myself versus paying a professional, and the reason for that is that I can take my time and I can let the software prompt me for every single deduction that I might qualify for, whereas if you go to a pro, they may be in a hurry and just give you the common things, and you may miss out on some deductions and not get as big of a refund. And so for that reason, I like to file my own taxes. A few years I missed out on the state tax deduction for the 529 college savings because the professional tax preparer just didn't ask me and I didn't know that I could get a state deduction. So anyways, first things first, to understand the US tax code, you need to understand the marginal tax brackets. If you've never looked at them before, you should Google it and bring up something like this. And the United States has what's called a progressive tax system, and that means as you earn more money, you pay more taxes. But that's where the first misconception comes in. A lot of people will think if you're a teacher couple making $175,000 a year that you're in this 22% bracket, meaning that you pay 22% on that whole $175,000. In fact, that's not the case. In money that you make from 0 to 20,000 is only taxed at that 10% bracket, and then money that you make from 20,000 to 83,000 is taxed at that 12% bracket, and then finally any money that you make from the 83,000 amount to the 178,000 would be then taxed at that 22% bracket. And one more thing to clarify is that actually, because of something called a standard deduction, and I'll talk about it a little bit, 44% of Americans actually don't pay any federal income tax at all because they just don't make enough money. And so for single filers this year, that standard deduction is about $13,000. So if you're making less than $13,000, you don't pay any taxes, period. For a married couple, if you're making $26,000 or less, you don't pay any taxes, that standard deduction. And then for head of household, if you make less than $19,000, because of that standard deduction, you won't pay any taxes. So essentially, you can almost add $13,000 and $26,000 and $19,000 to these rows, because you won't be paying any federal income taxes on that standard deduction. Or if you itemize because you've got a big housing interest or property taxes or medical bills, then that number could be even larger, but about 95% of Americans use that standard tax deduction. So that's going to be important with the next step that I'm about to show you. So why does this all matter anyways? Why don't we just pay these taxes and move on with our lives? Well, the government gives you some nudges to do the right thing, and in this case the right thing is to, once you start getting into these higher tax brackets, if you can defer those taxes by saving for retirement, which is the thing the government wants you to do, then you don't have to pay that 22% on your income right away. You can invest that into your retirement plan and then pay taxes later down the road, hopefully when you're in a lower bracket. So that's just a nudge that the government tries to do. Now, in my mind, paying 10 or 12% of income taxes is pretty reasonable. I doubt that we'll ever see numbers go much lower than that. So any money that a teacher has left over, or family, remember after adding the 26,000 to this 83,000, which is about 110,000, if you've got any money left over up until that 110,000, remember it's just going to be getting taxed at this 12%. So in my opinion, you would want to consider putting that into your Roth IRA, your Roth 401k, your Roth 403b, because you pay taxes on those Roth accounts now, but remember it's low taxes, 10-12%, and then all of the returns that they make until you withdraw them later in retirement, all those earnings are going to grow tax-free, which is awesome, because then you can take out all of this money in retirement, and those earnings, you will never pay a penny of taxes on those. And so that's important because you're down here in this 10-12% bracket. Now in my mind, for the average teacher, when you jump up to this 22% bracket, that's a pretty big difference in my opinion. And so this is where I would like people to start thinking about once you get over this point. So once you add the 26,000 or so to this 83, it gives you about 110,000. I'll show you on the next screen. At that point, boy, wouldn't it be nice not to pay the 22% taxes on that income, which the government allows you to do by deferring those savings into your retirement plans. So I want you to think about these 10 and 12% as your Roth zones, any money that you've got left over after your living expenses. If you're staying under that 110,000, man, put that into your Roth IRA, Roth 401k, Roth 403b. Money that jumps up here into this 22% bracket, try to defer that taxes down the road until maybe you're in a lower bracket in retirement. Even if you're not in a lower bracket, remember that because the taxes are being deferred on that amount, you're not paying any taxes on them initially. It's going to allow those retirement accounts to grow bigger, faster, and bigger. And maybe over 30 years, those accounts could be twice of what they would have been had you been paying ordinary income taxes on those from the get-go. So I've made this little spreadsheet that you're welcome to play around with. I'll put a link to it. It's certainly not perfect, and there could still be some mistakes that I need to iron out, but it will give you, I think, an idea of where you might want to start stashing some of your leftover money. So these two green rows are the only rows that you need to mess with. And so if you're single, married, or head of household, you'll put your household income here. It doesn't have to be perfect. Unfortunately, we just might not even know what our income is or our spending is. And then down here, guesstimate your yearly expenses, and then some calculations are going to happen, and I'll show you those in a minute. But I just want to show you this first white row here is the standard deduction for 2022. And so I've told you it was about 13,000, 26,000, and about 19,000. And then here's that 12% bracket. And so what I've done here in this yellow row is added the standard deduction to that 12% bracket to give you kind of that total, and I'm calling this the Roth zone. So in other words, any money that you have left over from spending between this Roth zone and your spend, that is going to go hopefully into your Roth contribution. So in this example, I have this couple making 150,000, spending 75,000, and that Roth zone puts them at that 110. So if you did the math, they've got about 35,000 left over from these yearly expenses to this what I call this Roth zone. So they should go ahead and stash about 34,000 into their Roth retirement accounts. And then I broke that down into a monthly. So that would be for that family about 2,870 that would go in per month to their Roth IRA, hopefully first, their Roth 401k, Roth 403b, and use up that space, because remember it's at that point only being taxed at about 10-12%. So money that's over and above that, so they've made 150, That Roth kind of cutoff is about 110. So if the spreadsheet does the math, that leaves you at about $40,550 for your traditional contributions. So in other words, you and your spouse should then be putting about $3,379 a month into the traditional 401k, the traditional 403b, the traditional 457. So that's kind of the sweet spot if you want to really maximize those tax brackets. A few things. One is that if you can afford to pay the taxes right now, go ahead and knock yourself out and put everything into Roth, because I don't think anybody's going to complain later down the road that they're not paying any taxes on money they're withdrawing from retirement. But just know that you might be able to really maximize it a little better if you split some of that up, and some of that money that would have been taxed at that higher 22% marginal rate goes deferred into one of your traditional accounts. And you can play with these numbers, so maybe you get a raise, and you can see that these numbers will adjust. So in this instance, that bumps that traditional up to $65,000, so that you're not paying that 22% right now on the $65,000. You'll be, whenever you retire, whatever rate you're in at that time, you'll be paying that tax percent from that marginal rate at that time. So I'll try to put a link to this. Just want to give people something to think about and play around with. Again, if you utilize these tax deferred or Roth accounts wisely, you're really going to do a lot better in retirement in terms of the tax part of what you're going to be paying on these plans. Anyway, thanks for watching. Hope you learned something. Please give me some feedback down in the comments.